All right, let's dive into leveraged ETFs today. We're going to tackle the question of if they actually work for long-term investing.
Yeah.
Um, you've shared some excerpts from a podcast episode. Let's see, the title is How to Optimize Long-Term Investment Through Leveraged ETFs, Keys to Risk Management and Asset Allocation 3.
Okay.
And some articles, too. So are leveraged ETFs all they're cracked up to be, or are they too risky?
Well, I think what's interesting about leveraged ETFs is that they kind of make people excited,
Yeah.
for those amplified returns.
Yeah.
But then people kind of get scared about all the risk and the volatility.
Yeah.
So today we're going to try to unpack all of that and see if they live up to the hype.
Okay, let's just get right to it then. A lot of people say that leveraged ETFs are just not good for long-term holding. What do you think about that? Yeah, and there's definitely some truth to that, because of the daily rebalancing and the compounding. It can work against you over time. But our source material here makes a really important distinction between leveraged ETFs that track individual stocks
Okay.
versus ones that track a broader index.
So like if you're tracking the S&P 500,
Right.
that would be different than like just a single stock.
Exactly. And there's a great example in the podcast. They said, imagine a stock, okay, and this stock has a crazy day where it goes down 10% in the morning.
Oh, wow.
And then in the afternoon, it goes back up 10%.
So you break even.
Right. You'd think so. But if you have a leveraged ETF on that single stock, you're actually going to be down because that 10% drop is actually a 20% drop.
Right.
And even though it went back up 20%,
Yeah.
you're still down overall for the day.
Wow. So those kinds of swings can really affect your returns, especially if it's over several days.
Yeah, exactly. But with an index, you get the benefit of diversification, right?
Hmm.
You have all these different companies, so some might be up, some might be down.
Okay.
And it kind of smooths out the overall performance.
So it seems like those individual stock leveraged ETFs might not be so great for the long term, but those index-based ones maybe could work.
Yeah, that's one of the insights. But what's really interesting is they make the case that even with those potential losses from the volatility drag, there's still a lot of potential for big gains.
Okay.
They actually, they walked us through a hypothetical 10-year investment in the S&P 500, SPY,
Okay.
and also the 2x leveraged version, which is SSO.
Yeah, I'm listening.
So they said, let's assume the S&P goes up 100% over 10 years, which is, pretty reasonable for the stock market long term.
Yeah.
And they factored in that drag, the drag from compounding losses, for the 2x leveraged ETF. They estimated about 4% per year.
Oh, wow, that's a lot.
It's a decent amount. But even with that drag, the 2x leveraged ETF still ended up almost doubling the return of just the regular S&P 500 ETF.
Ooh.
So it really highlights the power of those amplified gains.
Yeah, that's pretty impressive. So if those leveraged ETFs are supposed to, like, double the returns, why are they always right on the money with that 2x target? I think a lot of people are wondering about that.
Yeah, it's true. It is kind of a myth that they're always going to perfectly double the return, and I think that's where a lot of the frustration comes from. In theory, yeah, 2x looks great.
Right.
But in reality, the markets are complicated, and you don't always hit that exact target.
Okay, so what gets in the way of those perfect 2x returns then?
Well, the source material outlines 3 main risks. So first, we already talked about the intraday price swings
Right.
that affect the rebalancing. The second risk is market liquidity.
Okay.
So that's how easily an asset can be bought or sold.
Got it.
Leveraged ETFs are constantly rebalancing, right? So that means they can be more affected by transaction costs, especially during those volatile periods.
But even small fees can add up.
Totally, yeah. And then the third risk is what they call unexpected events. So like sudden market crashes.
Oh, yeah.
Geopolitical stuff that nobody sees coming.
Like a black swan event.
Exactly. So that's another layer of uncertainty when it comes to getting that perfect leverage. Yeah, those can really throw everything off. So with all those risks in mind, let's talk about some actual strategies for using leveraged ETFs, especially for the long haul. It's one thing to get the theory,
Right.
but how do you make them work for you in real life?
Yeah, I think that's what our listener really wants to know.
Definitely. And the podcast episode, they really hit on risk management, which is crucial. Obviously, investing always has risk, right?
Of course.
But with leveraged ETFs, it's about managing that risk.
Yeah.
So you can still try for those bigger returns without getting totally wiped out.
So what kind of things can you do to manage risk with these leveraged ETFs?
Well, dollar cost averaging is a really good one. They talk about that.
Oh, yeah, that makes sense.
So instead of just saying that, though, let's, imagine you want to invest $10,000 in a 2x leveraged S&P 500 ETF.
Okay.
You could put it all in at once, but that's risky.
Yeah, what if you buy at the peak?
Right, exactly. So with dollar cost averaging, you'd spread it out, maybe like $1,000 a month for 10 months. Doesn't matter what the market's doing.
That way, if it goes down, you're buying more shares at a lower price.
Exactly.
Okay.
And then when it goes back up, you're not buying as many, so it averages out.
So it really helps smooth out those big swings you were talking about earlier.
Exactly.
Yeah.
Yeah. That's perfect for leveraged ETFs. Now, they also mention using moving averages to figure out when to buy and sell.
Ah, moving averages. So this is getting into like the technical analysis side of things.
Right. So for people who aren't familiar with that, a moving average is basically, it's a line on a chart, right?
Mm.
And it shows the average price over a certain period, like 50 days, 200 days.
Okay.
So traders use these lines to spot trends. For example, if the leveraged ETF's price goes above its 200-day moving average, it might be a good time to buy.
Like it's trending up.
Right. And then if it goes below, that could mean it's time to sell.
So it's a way to see the bigger picture.
Yeah, to kind of cut through all the daily noise. Of course, no indicator is perfect, but it can be a helpful tool.
I see. They also talked about something called hybrid allocation. What is that?
Yeah, so that's basically about not putting all your eggs in one basket, right?
Okay.
So you have some leveraged ETFs for growth, but you also have other stuff like bonds, real estate, commodities.
And even just regular index funds.
Right, exactly. So that if your leveraged ETFs take a hit, you've got something else to cushion the blow.
Makes sense. So what about when you want to actually reduce losses within your leveraged ETF holdings? What can you do then?
Well, that's where hedging comes in.
Hedging, that's a term I hear a lot. But what does it actually mean?
Yeah, so basically it's like insurance for your investments. One common way to do it is to have some assets in your portfolio that tend to do the opposite of the market.
Okay, so give me an example of how that would work with a leveraged ETF.
Sure. Say you think the tech sector is going to do really well. So you buy a 3x leveraged tech ETF.
Right.
To hedge that, you might also buy a smaller amount of an inverse ETF, one that actually goes up when tech goes down.
So if tech crashes, you don't lose everything.
Right. Your losses in the leveraged ETF are offset by the gains in the inverse ETF.
Clever. But I guess hedging also has its own risks, right?
Absolutely. It's not free. And it can also limit your gains if the market goes the way you want it to.
Right.
So you have to be careful and think about if it makes sense for you.
So we've covered a lot of strategies here.
Yeah.
But does the podcast episode actually give any proof that these things work in real life? Or is it all just theory?
That's a good question. And yeah, they actually talk about that. They point out that even though leveraged ETFs don't always perfectly double the market returns, they still tend to do a lot better than regular ETFs over time, especially in those bull markets when everything's going up.
Right.
And they mention a bunch of studies that have looked at the actual performance of leveraged ETFs historically, and the numbers seem to back them up.
So it sounds like there's some evidence that these strategies aren't just made up.
Right.
But what about when the market's not doing so well, like in a bear market? How do leveraged ETFs handle those downturns?
Yeah, that's where things can get a little hairy. They do acknowledge that leveraged ETFs can lose a lot during bear markets, because those losses are magnified.
So it's a double-edged sword, big gains in good times,
Right.
but also big losses when things go south.
Exactly. And that's why those risk management things we talked about are so important.
Right.
It's about navigating the ups and downs.
Right.
So you can come out ahead in the long run.
So it sounds like leveraged ETFs aren't for everyone.
Definitely not.
But if you know what you're doing and you're not afraid of some risk,
Yeah,
they could be a powerful tool.
for sure. It's all about finding that right balance between risk and reward. And that balance is going to be different for every investor.
Okay, so as we wrap up this deep dive into leveraged ETFs, what are the key takeaways for our listener?
Well, I think the biggest one is that they're not good or bad in themselves. It really depends on how you use them.
Like any investment,
Yeah.
you got to have a strategy.
Exactly. You can't just throw money at them and hope for the best. You need to understand the risks and how they fit into your overall goals.
Yeah, and I think we've seen how important it is to choose the right kind of leveraged ETF, like those index-based ones.
Right. Instead of just chasing those single stocks, especially for long-term investing, you want that stability and diversification.
And that whole thing about 2x returns, it's not always going to be exact, and that's fine.
The point is that leveraged ETFs can really help you grow your wealth faster, even if they don't perfectly double the market's return.
Yeah, that 10-year example from the podcast was pretty eye-opening.
And that was just looking at market appreciation. Imagine if you add in dividend reinvestment on top of that.
Oh yeah, those dividends can really add up over time.
So, the source material really emphasizes that leveraged ETFs can be powerful tools for reaching your financial goals. So I guess the question for our listener is, how does this all resonate with you?
Yeah, has this deep dive changed your thinking at all?
Maybe you're thinking about adding some leveraged ETFs to your portfolio, or maybe you're even more sure about sticking with your current investments. Whatever you decide, the important thing is to make informed decisions.
And we hope this deep dive has given you the knowledge you need to do just that.
It's been great exploring this topic with you. Always fascinating to dig into these financial instruments and see how they can work for investors.
Thanks for joining us on this journey into the world of leveraged ETFs. Happy investing.